Hey guys, I am Deric. Welcome to my channel. In this video, I'm gonna talk about the risk and return of single asset. When we invest, our target is to make good return. Return represents the total gain or loss on an investment. The most basic way to calculate return is by using the following formula. Cash flow received plus current value minus previous value over previous value. Current value is the sale price while previous value is the purchase price. The difference between purchase and sale prices is called capital gain. So this formula can also be expressed as return equals current income plus capital gain over purchase price. Let's take an example. Johnny wishes to determine the returns on two of the company's projects, Project X and Project Y. Project X was purchased 1 year ago for $20,000 and currently has a market value of $21,500. During the year, it generated $800 worth of after-tax receipts. Project Y was purchased 4 years ago. Its value in the year just completed declined from $12,000 to $11,800. During the year, it generated $1,700 of after-tax receipts. For Project X, $800 is the current income, $21,500 minus $20,000, you will get the capital gain, and $20,000 is the purchase price. By applying the formula, you will get the return, 11.5%. Similarly, for Project Y, you will get the return, 12.5%. So, based on the answers, we may conclude that Project Y has a higher return than Project X. There are in fact two types of return. First is expected return. This is the return that an investor expects to earn on an asset, given its price, growth potential, etc. Second is required return. This is the return that an investor requires on an asset, given its risk and market interest rates. The expected value of a return, R bar, is the most likely return of an asset. It can be calculated based on this formula, in which we take summation of all return of the outcome times the probability of occurrence of the outcome. Let's apply this formula. Under possible outcomes, pessimistic means the estimated lowest return, most likely means the mostly attainable return, while optimistic means the estimated highest return. Probability for pessimistic is 0.25, most likely is 0.5, while optimistic is 0.25. For asset A, the lowest return is 13%, most likely return 15%, optimistic return 17%. By taking probability times returns of each possible outcome, you will get the weighted values for each possible outcome. Sum up these, you will get the expected return, 15%. Do the same for asset B, in which its lowest is 7%, highest is 23%, you will get the expected return also 15%. Based on past studies, historical returns for selected security investments between 1972 and 2020 are as follow. Small cap stocks have the highest average annual return, 12.7%. Followed by large cap stocks, with 10.8%. Long-term corporate bonds have lower risks, that's why the returns are also lower. Treasury bills have a return which is similar to bank fixed deposit interest rate. After talking about return, now, let's talk about risk. In the context of business and finance, risk is defined as the chance of suffering a financial loss. Risk is not a loss, risk is only the chance of suffering a loss. Assets, no matter they are real assets or financial assets, which have a greater chance of loss, are considered more risky than those with a lower chance of loss. Risk may be used interchangeably with the term uncertainty to refer to the variability of returns associated with a given asset. Take note here, risk is the uncertainty. Risk preference is how people feel about taking risks. There are three types of risk preferences. Risk-averse investors refer to those conservative investors who prefer the preservation of capital over the capital gain. They are unwilling to accept risk in their investment. Usually, they only accept low-risk investments with low returns. Risk-indifferent investors are also called risk-neutral investors. They evaluate investment alternatives by focusing solely on potential gains, regardless of the risk. Simply speaking, as long as the investments can provide the returns they want, they will invest, no matter the risk is high or low. We may say, risk-indifferent investors don't care about risk, they only care about return. Risk-seeking investors refer to those aggressive investors who prefer the capital gain over the preservation of capital. They are willing to accept high risk in their investments, as they only aim for high return investments. How do we compare the risk of a single asset? For example, Peter wants to choose the better of two investments, asset A and asset B. Each requires an initial outlay of $10,000, and each has the most likely annual rate of return of 15%. He has made pessimistic and optimistic estimates of the returns associated with each. The three estimates for each asset, along with its range, are given in the following table. Based on the table, the expected returns for both assets are the same, 15%. But the range of return for asset A is lower, which is 4%, while the range of return for asset B is 16%, which is higher. If Peter is risk-averse, most likely he will choose asset A, because asset A offers the same expected return, but with a lower risk. The most common statistical indicator of an asset's risk is the standard deviation, which measures the dispersion around the expected value. The expression for the standard deviation of returns, sigma, is given below. Sigma equals to the square root of the summation of r minus r bar square times probability. However, if the probabilities of the outcomes are not known, but assumed to be equal, then the standard deviation of an asset is given by this formula, in which the probability is not included, but replaced with 1 over n minus 1. Let's put it into calculation. First, fill up all the returns for each possible outcome. This is from the previous question. Then fill up the average return that we calculated in previous part, which is 15%. Next, take r minus r bar. After that, square them. Lastly, multiply them with the probability. Sum up the last column, you will get 2%, this is the variance. Open square root of variance, you will get the standard deviation, 1.41%. Alright, you may try to work out the standard deviation for asset B on your own. The answer is 5.66%. By comparing the standard deviations, we may conclude that asset B is more risky than asset A. Let's try another example. Consider the following information. You are required to calculate the expected return, the variance, and the standard deviation. By multiplying the probability with the returns, you will get the average expected return, 8.05%. By taking individual returns minus the average expected return, square it, multiply with the probability, you will get the variance, 26.75%. Open square root of the variance, you will get the standard deviation, 5.17%. Another important risk measurement for a single asset is coefficient of variation. The coefficient of variation, CV, is a measure of relative dispersion that is useful in comparing risks of assets with differing expected returns. CV is calculated by taking standard deviation over average return. Let's take an example. For asset C, take 9% over 12%, you will get the CV equals 0.75. For asset D, take 10% over 20%, you will get the CV equals 0.50. CV means 1 unit of expected return has how many units of standard deviation or risk, the lower the better. So asset D is a better investment alternative. CV is a better indicator, as it compares relative standard deviation based on same unit of expected return. By comparing these investments, based on the CV, the lower the better, we find that U.S. Treasury bills are better than other investments. Among these, small company stocks are least preferred, as it has the highest CV. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.